Hi, it's Mike Lynch with AmeriFirst Financial, and it's Monday morning, the week of July the 18th. It's time for your Monday morning mortgage update. So hope everybody had a great weekend. Gail and I did. We got a ton of stuff done, spent some time with friends, spent some time on the lake because it was hot and you want to be around water. And we took off to Mount Shasta Sunday evening and went to their weekly music festival in Solstice Park. Great venue, ton of room to put a blanket out, take some wine and some cheese and crackers, and the music was fantastic. And it was a lot cooler up there. So head up to Mount Shasta on Sundays if you want to have some cooler weather and listen to some great music. So what happened last week and what's happening this week? Last week, we actually saw rates stay pretty flat. They didn't get any better, but they didn't get any worse. And this is kind of surprising considering inflationary numbers were really high. The CPI, Consumer Price Index, was over 9%. The PPI, the Producers Price Index, was over 11. And these are key measures of inflation. And when we see inflation high, mortgage rates go up. And so that was bad for rates. We should have seen rates get worse. But there were some other reports that came out that showed that offset this. Consumer confidence, business owners' confidence, key measure of what people think and what businesses think the economy is going to do in the future was way down. And when the economy slows, when it's not performing very well, mortgage rates actually get better. And then we saw some other signs that the economy is not doing as well, inverted yield curve and some other things. And this offset those high inflationary numbers. So that's why we saw nothing change. Now, if we look at a graph here, I want to show you kind of what the rates have been doing. This is a representation of the trading of mortgage-backed securities in the bond market. Each one of these bars, if you see me move my cursor, represents 1 day of trading. And when we see green, that means money's flowing into the bond market and rates are getting better. When we see red, money's flowing out of the bond market and rates are getting worse. When we go back to middle of April, it was really flat. Rates really didn't move that much. And then the end of May, we saw money flow out of that bond market and rates got worse. And on June 14th, highest rates we've seen in 14 years. And then saw a little bit of an improvement in rates. Now, the media reported this as rates were dropping. Folks, they didn't drop. They got a little bit better. And a lot of buyers and sellers, a lot of people I've talked to said, hey, I heard rates dropped. I heard rates dropped. Well, if you look at the graph here, June 6th until today, a lot of those gains were lost. So the rates are not as high as they were June 14th, but they're definitely higher. Rates did not drop. There was a slight improvement, and we've lost most of that anyway. So just keep that in mind when you talk to buyers. A lot of people just read the headlines, and the media loves headlines. So that gives you kind of an idea of what's happening with rates. So let's look at the three things that are going to affect the market this week: artificial demand, central banks, and housing data. Artificial demand. What do I mean by that? Well, the Federal Reserve and private investors, 401k, your 401(b)s, day traders, we all invest in the bond market. And mortgage-backed securities, which is what affects mortgage rates, are traded in that bond market. So the Federal Reserve, there's a 30-year purchasing this week. Federal Reserve is going to be buying mortgage-backed securities. Now, we know they stopped buying them on the front end in March, and they did this so that they could raise the Fed fund rate. So they've been buying mortgage-backed securities on the back end, and they were supposed to stop that, but they really haven't. And this is Fannie Mae and Freddie Mac 30-year fixed mortgages. Fannie Mae and Freddie Mac are government-sponsored entities. Basically, you and I own them as taxpayers, and they own half of the mortgages in the country. And the Federal Reserve's buying these, and they're buying them at a higher rate than private investors are, and they're artificially keeping these rates low. And that is something to be aware of. If they back out of this, the private investors really they don't have an appetite to buy these, because if rates do get better, we're in a recession. Rates always get better in a recession typically. The money they're buying, the bonds they're buying now may not perform very well in 6 or 12 months if people refinance, if these rates get better. So it's kind of an interesting dynamic that's happening right now, but just know that the rates we're seeing right now is partially artificially low because of what the Fed's continuing to do. The second thing is central banks. So our Federal Reserve's meeting next week. They're going to raise that rate, Fed fund rate, 0.75 of a point. That's what they've been saying they're going to do. But last week with these high inflationary numbers, a big push for them to raise it 1 percentage point. And actually the bond market liked that, because bond traders are long-term. They don't like surprises. They look long-term. And if the Fed raises the rate 1%, even though it's going to hurt all of us in the short term, they see that as good long-term for the economy because it'll curb inflation. Now, something to remember is that if the Fed raises the rate 1%, it doesn't mean mortgage rates go up 1%. The Fed fund rate is the rate banks charge each other interest overnight. It's not a direct impact on mortgage rates. A lot of people don't understand that. But over the weekend, it was leaked that the Fed's probably only going to raise it 0.75%. And that caused the market, actually, pricing got worse today because, again, bond traders want to make sure that everything's good long term. The other central bank is European Central Bank. They're meeting this week, and they're expected to raise their Fed fund rate. Now, they haven't raised their Fed fund rate in a decade. It's a big move if they do this. They have bad inflationary problems over in Europe, and this is a great way for them to fight inflation. And our Federal Reserve, hats off to them. I'm not happy with them, but at least they're making some drastic measures in a short period of time to fight inflation. Housing data is the last thing. A lot of housing data coming out this week, Tuesday, Thursday, and Wednesday and Thursday. Not really going to move the market, but the reason I bring it up is because the media jumps on these reports. They misrepresent. They only look at the surface on a lot of these reports. We expect these housing numbers to continue to be strong, and just make sure that you have to look at the forest through the trees in these reports and see the numbers behind the headlines, because they're probably going to be fairly good, but people will look at and tap into some negative numbers that may come out and think that, the sky's falling on housing. And really, there's no indication it is. So make sure you interpret that information. Don't buy into the headlines. Advise your clients, advise your buyers and sellers on really what's happening. I'll come out with something midweek that'll give you some idea of really what these numbers look like when they come out, probably Wednesday or Thursday. Okay. So what do we expect this week? Well, we're locking this week. We're not floating. More opportunities to rates to get higher than lower. If you need any advice, input, if your clients need any help on mortgage rates, please let me know. You can look at my information down below and get a hold of me. If you know somebody who can benefit this video, please forward it to them. If you have any comments, I'd love to hear them. Have a great, productive week, and I'll talk to you next week. Bye.